The digital ad engine is firing on all cylinders. Communication services surged 2% today, lifting the QQQ despite a sharp retreat in real estate. While the broader market cowers at a fear index of 34, smart money is ignoring the policy noise to front-run a massive structural divergence in semiconductor margins. Today's 2.4% surge in the SOXX isn't a relief rally. It's a technical breakout confirming that hardware supply chains have already priced in the level 2 geopolitical risk. The SMH tape proves the hardware cycle is decoupling from the macro fear. VanEck Semiconductor ETF scores 63, a buy. 4068 is key. This signals a 10% chip yield boost. We're bullish on SMH, driven by this technical uptick, and our teardown reveals more. SMH jumped 2% today to $572.46. This move isn't about broad sector strength. It is about the 18.1% weight of NVIDIA. Jensen Huang joining the presidential delegation to China changes the structural risk profile of this entire fund. Wall Street markets SMH as diversified semiconductor exposure. The lab sees a concentrated bet on a three-company AI monopoly. NVIDIA, TSMC at 10.6%, and Broadcom at 7.8% dictate the price action. While analysts focus on trade rhetoric, we track the physical reality of the silicon supply chain. TSMC provides the advanced nodes while Broadcom handles the critical AI interconnects. These three holdings represent over 1/3 of the total net asset value. This concentration creates a massive performance drag if export controls tighten on high-end GPU shipments. The relative strength index currently sits at 75.7. This indicates the fund is technically overbought on a 14-day basis. Momentum is aggressive, but the structural density of the top holdings makes SMH vulnerable to single-point failures. You aren't buying a sector. You are buying a diplomatic negotiation. The marketing narrative promises broad tech growth. The engineering reality shows a high-stakes play on US-China silicon relations. SMH is currently a momentum engine masquerading as a diversified fund. The marketing narrative promises broad semiconductor exposure, but the engineering reality is a heavy concentration in a single pipeline. NVIDIA at 18.1% and TSM at 10.6% mean nearly a third of your capital relies on one fabrication ecosystem. We see a massive structural disconnect in the 7.1% allocation to Intel. Intel is a legacy turnaround play that dilutes the high-margin growth of Broadcom and AMD. While the 4,068% YTD return looks like an outlier, it exposes the fund's extreme sensitivity to megacap volatility. The lab tracks fund flows as current direction, and right now, that current is hitting a wall. SMH lagged the equal-weighted XSD by 17 percentage points over the last month. This proves that the broader chip market is rotating away from the giants' SMH overweights. The 49.6% concentration in just 5 names makes the diversified label pure PR fiction. You are paying for a sector ETF, but receiving a concentrated bet on a few specific balance sheets. When the top 5 holdings command half the net asset value, the fund ceases to be a hedge. It becomes a single point of failure for your portfolio. This ETF is an aggressive bet on a specific manufacturing bottleneck, not a representative slice of the silicon economy. SMH is a high-risk momentum vehicle that lacks the structural balance to survive a rotation into mid-cap chip designers. We're seeing a 5D/20D volume ratio of 1.27x. That's an inflow. Money is moving into the VanEck Semiconductor ETF. This signals institutional investors are positioning for growth in the sector. The ETF is trading at a 1.990% premium to NAV, implying strong demand pressure, with investors willing to pay more than the net asset value. Momentum is bullish, with an RSI of 75.7 and a recent bullish crossover in the MACD. The current macro narrative suggests tariffs are a major risk for the sector, but the lab disagrees. We see the data telling a different story. The fund's YTD performance of 4,068.8% contradicts the tariff uncertainty narrative. The lab's position is clear. The sector's growth drivers are outpacing trade war concerns. While mainstream media focuses on Trump's tariffs and trade wars, the lab looks at the data, and it shows a different story. The fund's top holdings are driving growth, and institutional investors are taking notice, as evidenced by the inflow. We're not buying the narrative that trade wars are a major risk for this sector. The numbers just don't add up. The lab's analysis shows the VanEck Semiconductor ETF is a growth story, driven by its holdings, not hindered by trade wars. The data is clear, and the lab's position is direct. This ETF is a buy, based on its fundamentals, not the macro headlines. We're seeing a 4,068.8% year-to-date gain in VanEck Semiconductor ETF, outpacing the Nasdaq benchmark. The top two holdings, NVIDIA and TSM, account for 28.7% of the fund, but reasonable diversification is maintained. The CNN Fear and Greed Index stands at 34, indicating a balanced backdrop for ETF exposure. While trade tensions between the US and China pose a risk, the trend of The reasoning for this verdict centers on the divergence between technical overbought signals and structural supply chain realities. While traditional indicators suggest a pullback, the underlying hardware constraints and margin expansion within the semiconductor sector provide a fundamental floor. The iShares Semiconductor ETF just hit $528, but the 5,300% year-to-date gain is a structural illusion masking a massive concentration risk. At the lab, we see the RSI sitting at 71.5, signaling an overbought engine running on high-octane fumes. While Wall Street cheers the Cerebra's IPO as a sector win, the real story lives in the 8% weightings of Broadcom and AMD. Broadcom is no longer just a chip maker. It is the physical toll booth for AI data center networking. AMD is aggressively pivoting its silicon architecture to challenge NVIDIA's dominance in the enterprise GPU space. Micron follows closely at 7.6%, acting as the high-bandwidth memory backbone that every AI cluster requires to function. These three firms dictate the fund's trajectory more than any macro headline. However, the geopolitical friction of the Trump-Xi summit in China creates a specific structural threat to these supply chains. Any export restriction on high-end lithography or advanced logic chips hits these top three holdings first and hardest. We are tracking a bullish short-term trend, but the technical divergence between price and momentum suggests institutional distribution is starting. Capital is rotating out of the hardware layer and into infrastructure before the next policy shift. The current SOXX price is a momentum trap that ignores the looming reality of trade-driven margin compression. The semiconductor rally has peaked, and a 10% structural correction is the next logical move. SOXX has delivered a staggering 5,340% return YTD. This is an engineered explosion of capital, yet the internal mechanics reveal a fundamental design flaw. The lab views this ETF as a high-performance engine carrying 6.3% in legacy deadweight. Institutional buyers are currently paying a 234 basis point premium over net asset value to own SOXX. This 2.34% premium signal proves demand is outpacing the creation of new shares. While retail headlines scream about trade war uncertainty in China, the 1.27 volume ratio confirms massive institutional inflows. We see capital positioning for a structural shift, not a temporary dip. With an RSI of 71.5, the fund is technically overbought. However, the moving averages tell a different story. The price sits well above the 50-day average of $393.83. This gap indicates a powerful momentum phase that ignores traditional cooling signals. The media narrative focuses on Taiwan and tariff risks under the current administration. The lab views this as a distraction from the hardware reality. These semiconductors are the non-negotiable infrastructure of the modern economy. You cannot build AI or defense systems without the silicon inside this ETF. Despite the macro headwinds talk, the flow data shows the smart money is ignoring the noise. They are buying the hardware backbone at any price. The premium to NAV confirms that institutional demand has decoupled from geopolitical fear. The lab identifies this as a clear signal that the sector's structural growth outweighs policy volatility. We expect the current momentum to breach the $554.70 resistance level shortly. The premium to NAV confirms that institutional demand has decoupled from geopolitical fear. SOXX is running red-hot with an RSI of 71.5, signaling a technical overheat that mainstream analysts are currently ignoring. While the marketing narrative promises broad semiconductor exposure, the structural reality is a massive concentration risk in AMD and Broadcom. These two architectures alone command 16% of the total net asset value. We see a jarring disconnect between the fear and greed index at 34 and this fund's aggressive price action. Retail sentiment is frozen in fear, yet the tape shows institutional capital is still aggressively positioning in silicon bedrock. The lab views these semiconductors as the physical engines of the global AI build-out. However, current tariff policies act as a direct tax on the semiconductor bill of materials. This is not a vague macro headwind. It is a documented margin compression that will hit the earnings of every constituent in this ETF. The lab's AI ETF score of 63 reflects this precise tension between massive momentum and rising hardware input costs. You should not chase this move toward the $554 resistance level while the technicals are this stretched. We are looking for a tactical entry at the $501 support floor. This level provides the necessary margin of safety before the next major product launch cycle triggers a structural breakout. The demand for AI compute remains the most powerful growth engine in the modern economy. By the inevitable volatility, not the peak. Both SMH and SOXX hit identical, high conviction buy signals today. Is this structural semi-strength a genuine breakout or a bull trap? Drop your take in the comments right now.